everyone. 8:30 start when registration is on, so I imagine we're going to have some folks trickle in, but in fairness to all of you who got here in good time and made your way through the process, we're going to get going. By way of introduction, my name is Gardiner, and I head up digital for Accenture here in Canada, and I'm super excited about the topic we've got here today. It's quite a laudable topic, democratization of kind of credit and lending through AI. So we can take this pretty much anywhere over the next hour together, and we hope we do. So what I'd like to do is introduce a couple of kind of colleagues and friends here to y'all, and then we're going to get going. And I think kind of we've made the call throughout this that we'd like to make this as interactive as possible, given the size of the audience. There's no reason to be that formal. So if you got something to say on anything that we're saying, put your hand up, ask a question, make a point, but we should kind of rumble around in this, a lot over the next 45 minutes to an hour or so together. So by way of introduction, we've got David Furlong. David is the head of ventures, AI and blockchain for National Bank. David's been kind of rolling around on the intersection of innovation and financial services for a number of years, and David and I actually got to know each other a while ago while we were working on setting the blueprint for mobile payments in Canada. So this has been a topic that's been evolving with him for quite a bit of time and has lots of interesting and perspective to share on it. We've got Yves-Gabriel Leboeuf, who is the... Thank you, YG. That's the only time I'm saying Yves-Gabriel, by the way, for the rest of this session, or YG. YG is a serial entrepreneur. He's the founding CEO of a really exciting Canadian fintech company called Flinks. We're going to explore more what Flinks does in our time together. As we've gotten to know each other, he's like an always-on guy. So we've got an Iron Man, flies planes, and says he doesn't sleep a lot, which is going to be handy. His girlfriend is going to have a baby in a couple of months. And in fact, he's cutting this so short, he's darting out from here to grab a flight to Montreal to see an ultrasound this afternoon. So, so the one thing I reminded of that no sleep thing is about to get a little bit worse. Right? So anyway, so we're going to have a little bit of fun with the topic. And again, let's make this as interactive as possible. Sightlines are this way, so if anybody wants to squeeze in and kind of make it our own fireside, feel free to do so, and let's get going.
Perfect.
All right. Gentlemen, welcome.
I would say Yves-Gabriel is always on, except for today. He left his cell phone in Montreal yesterday.
Yes.
So it's a bit dicey. Mm-hmm. Today he's always off.
Yeah. So in the session today, we had three kind of larger themes that we wanted to roll around in. One of them around just what are the advantages if you think about the intersection of artificial intelligence, machine learning, both within the existing models we have, but if we start to break down this concept of walled garden and start to move into open banking, how do we all think that's going to evolve, and what are the value propositions that are out there for the participants, be it the consumer, kind of lender, credit, and then the third parties that want to bring some value to this into this area. We'll also spend a little bit of time on, as we kind of go around in this, and what are potentially the risks of the unintended consequences. And what might be some of the positives of the unintended consequences, depending on kind of how you view these things. And then a good exploration of what needs to change, what are some of the inhibitors, what might be some of the enablers, and collectively for people who are interested in this space, kind of how might we propel Canada to the forefront of the value that's at stake here for all of us. So those are the areas that we thought we would explore. We don't have to do them in any particular order, so as I said, we're going to kind of kick this off and see where it takes us. All right. So why don't we start with the first one? So David, I'll kind of kick it off with you. Sure. This is meaningless unless it changes something for a consumer or a business at the end of the day. So as you think about just the evolution of AI and the explosion of data and openness of platforms, how do you think about just the potential value and the value propositions that are emerging out there?
There's a couple of interesting things about the volume of data. Banks have always been very data rich, often insight poor, because we have large quantities of data over the last XYZ years that sits there. And what we've discovered is as we move forward, clients actually are expecting us to, in a positive way, leverage that data to make their lives easier, better, whatever. financial services is complex at its core. Like the concept is really simple, but when it boils down to you making a personal choice about which house to buy, where to invest your money, how much you should save, when you should start saving, whether you should pay down a specific piece of debt or not, those are complicated decisions. So the more data we have about an individual, the more we can help them through that. Now, the interesting thing for us is as the data streams become more and more and more intense, traditional models and traditional approaches just don't work, or don't work as well. And some of the traditional approaches aren't actually able to handle things like unstructured data, like documents, video, etc. So you have to bring all of that together into an ecosystem where you can apply AI to get better insights to help your clients achieve what they need to achieve. And as we look at emerging business models and technology trends that are out there, there's some fascinating things underway today. And we can come back to these later. But there's some companies out there that I have a great deal of admiration for, aside from my colleagues at Flinks, like MX, which is a company out of Utah, Square, which most people here would know, some of the things that Alibaba is doing in China. Like there's some fascinating things out there which we can dig more into, but I don't want to monopolize.
Sounds good. And YG, you've obviously picked this space to be an entrepreneur and to focus on driving some value. Maybe you can kind of take the folks through just the Flinks value proposition.
Yeah, sure. And actually, before I do that, one very interesting thing that David was talking about is the fact that in order to put or work AI and machine learning and eventually produce a model that actually can either take decisions or provide insight for lenders, you need the data behind it. And actually for financial institutions, it's quite easy because the amount of data that you've been aggregating for the past 10 or hundreds of years is massive. But when you think about smaller lenders or like even small boutique mortgage lending companies, data is a problem as well. And that brings me to kind of the value prop to answer your question, which is accessing the data as the first thing towards democratizing the credit through AI, and then enriching that data to provide better insight so people can actually analyze that data. And we have a very interesting use case, which actually happened to one of our employees. So he's a super brilliant guy, studied in France, moved to Canada, and he tried to get a credit card. But he tried to get a credit card and he was refused everywhere because he didn't have any credit file. But the guy had a $100,000 job, which is pretty good in Montreal.
Less so in New York.
And he was refused everywhere for the simple fact that he couldn't prove that he had money sleeping in France. He had a good credit file in France. So that's an example of accessing the data. But now enriching that data empower people to actually understand what's happening in that bank account in euros and whatever transaction that you can actually look at. And that's what we're doing at Flinks. We access and we enrich the data so people can actually take better decisions.
Let me pick up that thread. No client wants to be treated as a product, right? Like everybody wants to have a relationship, or it's been our experience, and that's the type of client we want to work with. They want to be treated holistically. And the thing is to believe that every single financial asset for a client is going to reside at a single firm. Now, we'd like that, but that's not realistic. So, part of what you're able to bring to the table is we can actually allow people to bring together their total profile. And then we can look at that individual as a client versus you have this product. Right? And it makes a big difference to how we're able to support and serve a client over the long haul.
Absolutely, yeah. And that's why I think the enrichment component, which touch AI at some point, because in order for one institutions, and when I say institutions, not necessarily financial institutions, but in order for one organization, I would say, to assess the data, there's a lot of work to be done, and that takes either massive amount of data, but also a good AI model as well.
Okay. And I guess we touched on it a little bit, so I think we probably have people in the audience that have varying degrees of understanding about AI. Oftentimes there's a perception it's the kind of robot at the end of the process, the one that's making either the recommendation or driving whatever the outcome is. Maybe you could take a step back for the folks here and just talk a little bit about the uses of machine language AI or other kind of artificial intelligence technologies, throughout the chain to because it's a pretty composite picture.
Well, I'll give an example of something we're doing with National Bank. So basically, AI is a very large subject these days, and one of the portion that people consider AI these days is machine learning, even though it has been something for quite a while already. But one thing we're doing is that with the help of National Bank, we're running machine learning between the transaction behavior of consumers and the repayment history of the loan. So we're actually able to get insight from the transaction and state if that person will actually reimburse his loan or not. And that's it's pretty interesting, and I'm sure David will comment that as well. But that kind of creates a lot of use case and a lot of, I would say, granularity on how you analyze credit. Because as an institution, not only you want to try to give better credit to people that can actually take credit, but you also want to keep your loan portfolio healthy. And one of the challenges that with the traditional credit model, you often will be able to pull the credit file every month, every 2 months, or every 3 months, but you're not able to assess the current picture of the customer. And you're not able to assess the current picture of the customer because you don't have the capability of using that data. So what's interesting is that this is a very cool use case for what we call pre-delinquency, where we can actually assess the current picture of someone that could have had a change of job, change of salary, lawsuit, divorce, or whatsoever.
If you step back and you say historically we've done point-in-time analysis to give someone a score, that has always been useful for us and will continue to be useful. But what is equally useful is the concept of directionality. So you started a couple of minutes ago, YG, with the concept of new to Canada. And one of the valuable parts of directionality is if you do a raw score on new to Canada, it's going to be quite low.
Yeah.
Because the scoring models aren't designed to handle that. But what you can do is if people's transaction patterns are really positive, you can actually infer from the directionality that this is a creditworthy client and actually invest in building a relationship with that client sooner. So if you want to talk about democratization, what you're starting to do then is you're starting to bring access to people who traditionally have had to wait much longer to get access, because you can see directionality. I mean, if they have, your specific colleague who good salary, paying everything off routinely and saving money, that's great directionality, but their credit score in a traditional model is still not going to be strong. It's when you leverage the two to make better decisions for your client that you're actually adding value over and over.
And you actually have the opposite from newcomers to Canada that has a good behavior in repaying everything. You have the traditional millennial, new job, $140,000 a year, not paying his cell phone bill on time, not paying his internet bill on time, doesn't really care, but has a couple $1,000s in the bank account. Hello.
You don't have to be a millennial, by the way. So my bank makes too much money on my missed payments. So.
But I mean, the entire idea is that that person is not necessarily risky. That person is just not paying his bill on time. And I mean, that's a fact, and that's kind of the new way people will interact with credit. But also, that's also why institutions and organizations have to assess and leverage the behavior with the money in the bank account, rather than just do you pay your bill on time or not.
Yeah, I mean, if I'm raising my credit, but on the other side, I'm buying really quality investments, a traditional credit score will say my credit is increasing, not taking into account that it's going into investments.
Correct.
So.
You kind of both touched on a little bit about the edges of perhaps this kind of concept of democratizing, whether it's in kind of lending or credit or payments. And the edge case you talked about is poor payment history perhaps, but kind of affluent enough and kind of new to country. Are there any other kind of ways that you think about now with the data that's either available or the data that might be coming available as we kind of open up these platforms? Where are the areas that people should be thinking about exploring around kind of new value propositions? And we can take this from other countries.
I mean, even if we just think about the Canadian market, I think what's interesting and what's happening right now is that we will probably see more and more competition with the bank through organizations that already have data, but have never did something called lose to learn. And the lose to learn kind of concept is that you're going to lend money to everybody, and then you'll assess what behavior you don't want to lend money to. And that's how financial institutions were built back in the days. That's how new lenders, SMB lenders, or even new organizations starting to lend money in a new market are doing it right now. So I think the aspect of democratizing through AI is actually very interesting by leveraging the data that some company already have, and that can actually be very useful in creating models for them to start into new line of businesses, and of course create a competitive landscape.
Yeah, David,
Yes, you hit on an interesting one, because small businesses run a great deal of difficulty getting credit, because they again are not rich with history of having grown or whatever, because they're small businesses. And if you look at, I mentioned earlier Square, and if you read anything about their strategy, public disclosures, what you can see is that they leverage the transaction data from a small merchant, that's all the data coming through, and they can see when a merchant may or may not need credit to continue growing their business, and then they proactively offer. But they only proactively offer to someone who they believe can also be a quality borrower. So it's really interesting, because a historical problem that they've had is, how do I get access to credit exactly when I need it, is now being solved by someone who's leveraging all of their data to put an offer in front of them. And when you look at that process, you start to take a whole host of things out of the way. If you're a small business owner, the last thing you're thinking about is, oh, my banking service for this, my accounting for that. What you're trying to do is grow revenue, get feet in your store or transactions on your website, and here you are, somebody proactively solving your financial problem. Right, that's where the next generation's going.
I think you had a question?
Yeah.
I'm just curious, obviously the more different pieces of data you have, the better. I think typical personal customer has 2 or 3 of the really great paying for products with you, and they have stuff elsewhere, credit cards, whatever. How are you, and you referenced the French bank, are you able to access data from other financial products outside of, in this case, National Bank? Or
So I don't want to do a commercial pitch, but I will.
But you should. And if you're going to do that, by the way, you may as well disclose the relationship with National Bank, and we get all the commercials on the table, and then,
But
make sure
our mission at Flinks is to organize the world's financial data. So on our roadmap, we are planning to connect with other banks. Yes. So we are planning to be able to actually pull data from a bank from France. For an example, that use case of newcomers to Canada, to be able to actually connect his bank account to, an example, ask a credit card at National Bank. Yes.
All right, so very novel, looking beyond the kind of traditional markers that you would have in your risk profiles. Interesting example with Square, who's kind of made a point of coming in and being part of the kind of payments and financial industry, so it's a logical extension for them. Kind of, we know here in Canada, you've got Shopify, for example, completely separate business, but now can monitor the strength of the merchants in their network and are offering, they call it cash advances, to be able to provide them some liquidity, no application, no credit scoring, nothing. It's just whatever you're doing that I can see is going to kind of give me a thumbprint for you.
Yeah.
So super interesting. Have you seen examples from other jurisdictions that might be pushing further from us, from Canada right now, with open banking, kind of third-party players, and now the evolution of just being able to do things with machine?
Yeah, I mean, we have to talk, they're not in Canada, but we have to talk about Affirm. Affirm is a very, very interesting model, founded by one of the PayPal mafia, ex-CTO Max Levchin. And they are now able to do it's POS financing, by the way. So when you actually go on an e-commerce, you can ask for instant financing instead of paying for what you're buying. They started doing 0% financing. And the reason they are able to do that is that they sell the data that they collect to merchants. So they are monetizing something else than the actual loan they are they are processing for the consumer. So that's, I think, is a very interesting business model. They're not in Canada, but still it's worth mentioning that in the line of discussions that we're having, leveraging the data once again to provide a better offer to the consumer is sometime in a completely other field that we're thinking.
Cool. And David, yourself, you kind of work from a global basis, scanning the world.
Yeah.
What's caught your eye?
You know, I had a good conversation with Alibaba, maybe 4 or 5 months ago, and they were explaining how they use AI in transaction. And what I was told, and the gentleman who was quite senior at the company was explaining that as a client scrolls through their application, so they have everything's phone-based. They're not really web-oriented. So as they scroll, based on the speed at which people are scrolling past specific items, they're constructing the next series of items to show real time. And then as they slow down, they start to hone in on exactly what the item is. And then when someone stops to click on an item, the personalization event becomes around pricing. So as someone's flicking through their phone, they start to slow down. And when they do, think about this, they start to dynamically change what they're putting in front of someone. And when someone slows down to a stop, they adjust the price. Like the extreme of personalization. And the only way that's possible is with, one, AI, because you have to dynamically go on a persona, and then 2, AI for pricing, and then 3, it's massive, massive, massive quantities of data, which they would have with hundreds of millions of users. But it's the convergence of those events allows someone to fundamentally redefine the experience. Because like when I remember at one point when I was heavy into the digital world, the concept of scrolling on a web page was a no-no, right? And then we moved to phones. And even on phones, we didn't want to scroll because it was a nuisance. Yet here someone redefines the experience using new technologies to encourage scrolling. Right? So it's just different ways of thinking about how do you get to the right thing for a client.
All right, so let's go off piste a bit. This wasn't something we talked about before, but you've kind of gone down this path. You know, when we started the conversation, we talked a little about credit, lending, kind of risk profiles, and how do we treat some people differently. But the examples that both of you just gave kind of were much more expansive than that. Yes, you may have had a credit product that might have been in the middle of it, but it's an overall experience. It's how do I target people? How do I reach them within context? So, what are some ways that you're thinking about, David, kind of you and the National Bank team, around how do I have to change how I even think about the term product, right? How do I have to change the new product or new experience development and explore and innovate? And you obviously spend time with lots of institutions. Maybe you can talk about how some of them are thinking about the same topic. Right?
So I'll start with the realities of organization. Like at some point, every bank has traditionally been organized by you have some people in the front office, some people in product, and some people in IT, and some operations people maybe sandwiched in the middle or with the business line. And we're discovering as we go the construct of offering products, right? Like. I don't want to offend any other banker in the room, but it's a commodity business. Products are the same. Credit card, even the size of a credit card is predefined. It comes with 16 digits. Even the colors are the same. So what really changes the game is...
So my black card's not that special? So you're trying to tell me?
It's no blacker than my black card. It really boils down to what experience you can create. So what we've discovered is that if we can manage things by value stream, where we put together in teams that are working... I don't want to use buzzwords, but we're working together dynamically where you get the product people, the operations people, IT people, digital and data all working together to solve something for a client. That works much, much better. Historically, in our organizations, and it's not just ours, they've all separated data from applications from business. And I don't believe that that's a sustainable model. In the future, there is only one model, and the model is digital. Now, you may choose to roll it out through a branch, through contact center, over a phone or whatever, but the concept of digital end-to-end is real. And the amount of data generated throughout that process is just insane. So, to say we're going to generate massive amounts of data, then you're going to analyze it, and then maybe come back to me later with something, a suggestion, that's just not real. It all has to be in line together. So it requires an enormous amount of behavioral change, process change, technical change to realize what the next generation clients actually want.
And
YG?
Actually, that's an interesting way of painting what's behind an organization, a large organization. And I think the glue for that really is to start with at least machine learning. Because the truth is that like the traditional credit model did use some machine learning capabilities, but the real truth is that when you actually start digging around the amount of data that you need to take the right decision, there's no other technology than machine learning to do that. Human analysis that still works for financial institutions, for SMB lender and whatsoever, is still a thing, but the truth is that this is really not the right path toward the right direction. So I think that's where the product has to evolve. The product has to evolve to use the data that organizations already have. And I think the how to do that is through machine learning and AI.
Cool. We have a question over here.
First of all, I love you guys are such a great example of how a bank has partnered with a fintech. You guys have done such
Thanks.
amazing things, so kudos to that. You mentioned competition, and you mentioned the whole end-to-end digital transformation. We're seeing an explosion of AI, ML, and we're trying to manage an entire customer experience. It could be operations and customer experience, it could be call center. How do you sort of imagine this now rolling out? Like, how are you going to manage all of these different algorithms, companies, internal, external, to deliver that exceptional customer service?
From our perspective, I would say, like, traditionally what you can fall into is I will select a partner and that partner will solve everything, right? That's not, no offense, Stephen, that's not,
We solve a lot though, right?
that's not real, right? So as much as someone like Accenture or their competitors can bring things to the table, we still need to work with firms who bring different assets, like technical assets, to the table. So for us, we've gone through an enormous amount of work over the last 18 months, call it, around the governance process around, first of all, making it super lean. Because we've gotten down our non-disclosure to a standard 2 pages. Right, and I know some of our competitors are still in the 60-page range for non-disclosures. And we get down to, we can get someone, when we put our minds to it, through the entire governance process to get them onboarded in like 2 to 4 weeks, which is a lot. Now that doesn't mean we've cut corners at all, but we've redefined what we do with cybersecurity and the level of talent we've invested there. Redefined what we do in terms of data and data governance and controls across the board. Redefined how we actually have gone through a procurement process, a negotiation process. And in my group, we actually invest in startups in Canada. So when we bring it all together, what we've had to do is change an enormous number of processes to get things through the door quickly. Now, we haven't cut any corners. We're no less safe, probably more safe than we were, because there's better communication internally. So teams that traditionally hadn't communicated, like you wouldn't believe how many times I've been on the phone all at once with cybersecurity, procurement, legal, and someone in a business line. Now, traditionally, if you're in a large bank, those 4 groups are never on the phone together. Or we're in a room together to talk about how we get something through the pipeline. But you have to have the willingness, courage, and stamina to go through that, because it's not trivial. So we've completely redefined our third-party risk management processes, all our cyber, the whole end-to-end, all of our data. Because we don't just we mask data, we encrypt it, and we encrypt it at rest, we encrypt it in transit. So you go through a whole series of processes around that. It's a lot of heavy lifting.
And on the fintech side, I would say, you cannot go and start working with an organization like National Bank by saying, yeah, I'm going to fix all your problems. I'm going to do everything. We're a 50% company and like no more problem for you.
But if you could.
So what we did is that we did focus on the thing that we knew we were good at. And for the rest, we partnered with companies, unfortunately not Accenture so far, but like Accenture. So a recent partnership for us is with Equifax. So we've done a joint partnership with them to come up with a solution for people that are between, I think, like 500 and 600 on the credit score. And we did that because we know we are not necessarily the best at, an example, providing the end-to-end solution to credit team for a large organization. So that's kind of like the story on the fintech side.
Yeah. And we could spend an entire hour on large organizations trying to adopt innovation from kind of fintechs, and there may be one of those sessions actually up and running here. So,
but to give you
super question.
Give you some sense, we're actively utilizing, working with, or have deployed in production over 30 startups as a part of our core value chain. We had to wrap our head around what does it mean to work with 6 people?
And not kill them with process.
and not inundate them with process.
That's it. We hit on a few things there, so maybe that's a good chance to pivot to the kind of second area of discussion, which was just in around this concept. Oh, got a question first.
Yes, I have a question. You have talked about accessing data and sharing data as a way to democratizing credit, but I see that it's mainly come to consumers. What do you have any comments about doing the same for business to business solutions? In a sense, you, the banks, you have business financial information on business, and then do you see at any point in time be able to also access others access to that information in order to provide better service to businesses, the same way that you are doing now, sharing that data, or potentially going to share that data and access to that data for consumers?
I mean, that's a great question. And the vision that we have is that, yes, innovation should happen as much on the consumer side as on the SMB side. My perspective on that is that the lending industry in Canada, depending on who you deal with, is potentially a bit more advanced for SMBs than it is for consumers. A good example is Square, that can actually provide lending for you based on the transaction processing to like their platform. But I think it's at least it's the vision that we have to provide the same level of innovation to the two kind of pillars of the Canadian territory.
Yeah, I have a colleague in the back from our commercial banking team who'll promptly hide. But we've been pretty aggressive in experimenting with this as well. So we actually offer thinking capital, and if you don't know that, it's a small business lender based on behavior. So we actually offer that to our clients through our digital channels. So we're a big believer in its. Once you get to a certain size of commercial, that doesn't really work because someone has lots of tangible net worth, big assets and stuff. But if you can consumerize or score stuff, the technologies and approaches are the same. Where it gets really interesting for bigger clients is you can start to attack things with them like fraud. Or like most of you guys are here for a payments conference. So like I'll tell you, most of the data in our company outside of web traffic, like most of the product data, gets generated through payments. That's where it all comes from. It doesn't come from, if you have a mortgage, you pay the mortgage either twice a month or once a month, not a high volume event. Whereas you use your credit card, debit card, or if you're a business, you're using wires, et cetera, routinely, and with lots of data associated with it. So those are the elements. Anywhere where there's lots of data, AI, machine learning, data aggregation works really, really well. Okay. So we're in the middle of all of that.
Cool. All right, so let's pivot. All right, one last one, and we're going to pivot to the next section after this one. Okay, go for it.
Have you seen AI applying? I know finance industry has been kind of a pivotal point for AI, but has there been other industries, like I come from transit industry, do you see a use case where AI could be applied in a non-financial sector?
Oh God, yes.
Like you do payment all the time.
In the payments, but non-financial payments, okay.
Yeah, you can jump in on this one. For those of you who don't know, there's an AI supercluster being built out of Montreal, and it's solely and wholly focused on supply chain management and logistics. And some of the early use cases are shipping at the Port of Montreal, either through boats, trucking, another big use case has been train scheduling for shipments, and then we're moving on, it's being moved on now to the supply chain for electricity generation. So consumption, utilization, optimization. So yeah, it's not in any way exclusive to financial services.
Yeah,
and even like self-driving car.
Yes.
But the thing is, most of the time, it's hard to put these models in production. Because would you trust a self-driving car today? I would personally, but like most people won't trust self-driving car as of today. So it's similar to what we're living in the financial industry, where putting a model in production is a bit hard because you have to prove that the model is working properly. And an example in the financial industry, some large organizations want to see the model perform over a full economical cycle, which is like 10 years. So it takes time. Yeah.
Yeah.
All right, into the next area, which is just this concept of unintended consequences. So when you talk about AI, and you talk about the financial services industry opening up its platforms and making things kind of more open, I think people get excited. But the other part of it is there's a little bit of unknown, and they have a perceived risk, whether it's real or otherwise. And so maybe we'll have a question for, kind of start off with you, IG, on just as you've gone into institutions and you're taking them down this path of unknown, a little bit of a voyage of discovery on what you're going to find. And how are you thinking about it, and how are you seeing others thinking about this, the unintended aspects of what we're talking about?
I mean, like there's a lot of questions about the model that could be put in production, and there is like horror story in the US of model being put in production that are highly discriminatory, where like people in a certain neighborhood couldn't have any loan, never. So that's the type of thing that models should stay away. But what's interesting is that since there is no human bias behind these models, it's actually easy to adapt these models to use only data points that are not biased at all. So it's kind of like all comes up to properly building the model, properly testing the model. But I personally think that removing the human equation of the entire model make more sense than actually trying to say that everybody's going to be judged the same through human analysis.
David?
So there's a really interesting point that YG just hit. In a traditional model, what happens is my colleague Tom here from TD, he will get together, he's a really smart guy, and he'll decide based on his observations, what he's seen in data, to create a model. And he'll actually model, based on his experience, expertise, and so on. So now built into that, obviously, are his biases and what he's seen, his experiences. AI works very differently, and this is a little hard to wrap your head around. What happens is you get the data, you make sure the data is clean, quality, and good, and then you apply understood algorithms or techniques. It's not the human picking out the pattern, it's the machine. So this is the weird part, right? So in the case of an individual creating a model, then we have to work on understanding or capturing their biases to make sure we eliminate those. In a machine construct, the way we can eliminate those biases is one, through what data we feed it, and two, managing it after. So I'll give you a really good example, and it's kind of funny, of weird things that show up in data. So there's a large European telecom who was experiencing quite a bit of turnover in a market. And so they took all their data for the clients, put it into the modeling ecosystem, and it came out and said, there's an X% chance that anybody who owns a cell phone with 4 capital letters in the name will leave. So well, this doesn't make any sense. And sure enough, it was super predictive. If there was 4 capital letters in the name, the client was leaving. And then they uncovered the data and figured out that the 4 capital letters were BYOD, bring your own device, which meant someone came in with a phone and said, I want a contract for a month. Yeah. Of course they're going to leave. They were only signing up for a month, right? But this is the difference between, the machine said, yes, it's very predictive, which was true. But the data itself was what was causing the outcome. So what you have to be very careful of going forward is, what data do you feed it? Like, you can't feed it social insurance number, because there's a way to determine if someone's native-born Canadian or not, based on their social insurance number. You can't feed it that. To your point, you have to be very, very careful about address. You have to be very, very careful about names, because what you don't want it to do is do a negative or even positive selection based on a name. right? Just because all Davids are creditworthy, which is not true, just to be clear. Just because, you know what I mean? That's not a good reason to give David a loan, because the other 10 Davids were creditworthy.
Like even the transaction description, you cannot necessarily use the transaction description with non-bias because of the fact that some people will tend to shop here and there more than other people. So you have to enrich that data at some point to anonymize in some sort of way the data that you get at the source through an example categorization. So every grocery store gets categorized as a grocery store.
Okay, there's going to be lots of questions on this one, so here we go.
Good question for me. When do you inject human interaction into the data analysis when you're dealing with AI? How often and when do you have that checkpoint to see that things are going the right direction?
For us, it's in data construction, that's done with the human team, and we have a set of rules as what to exclude. Then when it produces, we actually typically have the data blinded, so a human can't see it, but then when we get features, we'll actually sometimes uncover those features to ensure that there's nothing discriminatory in the feature. And then we have a secondary process, we're a bank, of governance where you have to go through an approval process. So we're pretty rigid on it.
We had a couple other questions. Tom?
So, I mean, you can feed the algo, you can train the algo, but the algo will still go towards or will spit out a desired result. For example, maximize profitability, not lower the losses, because that could result in no loans. But the algo still might say that an individual with a certain feature, might not be address or name, but some other highly discriminatory element, might get in there somehow. So how do you eliminate that truly unconscious bias? Do you start training the algo or requesting the algo to come up with some sort of an outcome that is non-discriminatory?
Here's a weird one, and this is, I just want to be very careful how I say it. Every decision in and of itself is a bias, right? If you've decided anything to turn left, turn right, doesn't matter, it's a bias, you have a preference. So credit models are an odd one, because if there was no bias in credit models, we give credit to everybody to an unlimited amount. There's a difference between what is a bias that is acceptable, or a decision set that's acceptable, versus one that is not. One that is not has anything to do with race, heritage, sexual preference, Those are unacceptable across the board. Acceptable biases are, I didn't pay back my last loan. Right? That's an acceptable bias. So what we always strive to do is determine what's an acceptable decision set and what's non-acceptable, and make sure that we're never driving an outcome based on the unacceptable. And it's interesting, because when you have humans when we used to have humans doing loans in regions, you could never see bias. It was nearly impossible, because there was no methodical way to bring it together, because it was granted, and you often couldn't analyze what wasn't granted. But as industry's grown more and more sophisticated over time, it's getting more and more centralized and more automated. Therefore, you can actually use algorithms to detect biases. So one of the things we do in the company is we actually run some AI stuff based out of with a company that we've invested in Montreal called MindBridge, or Ottawa, sorry, called MindBridge, and they're great at anomaly detection. So if something seems wrong, it pops it out. So we're using that for audit, fraud, everything internally. So one of our plans is to apply those models to other models to see if there's an outcome we don't like.
So there's a lot of discussion around the data that you use, and to make sure that you don't feed the model something that it shouldn't ingest. But with a lot of kind of modern AI, the models themselves are not particularly explainable. Highly predictive, not explainable. So maybe talk a little bit about how you're navigating that, because it's a large degree of trust goes with how explainable something is. Right?
I mean, this is something as a company that we decided to stay away for now, at least. So everything related with, an example, deep learning, or what they call a black box, where you can put data, get an outcome that is very, very powerful without knowing what happened between the two, is something that we decided to stay away. And there's a couple of reasons for that, but the main one is that if you actually want to do some work in the credit space in North America, you have to be able to give the reason of why did you accept or not to lend money to that person. So if you actually start using some deep learning technology that you're not able to trace back where in the decision process of the AI model you actually took the decision of not moving forward, then for us it's at this point in time useless. But there is way that are kind of starting to happen of actually finding, even though you're using things like a black box to find where the decision was made. But yeah, we stayed away from that for now.
Yeah. So
Yeah,
lots of stuff should remain in the lab, is what you're saying.
Correct.
There is that full spectrum, like YG said. Like, I mean, you know, we've talked a little bit about credit, but then you've got marketing, you've got fraud, you've got, you know, process optimization. Like, natural language processing is one where, you know, you're consuming documentation and picking stuff out of it, and nobody really cares what model you use, just that it's accurate and works, because you're reading documentation. So, like, the interesting thing for us is we have an enormous number of opportunities to use the full spectrum, and it's choices, intelligent choices about where you use base ML credit to whatever gets the job done, you know, reading documents, voice analysis, and so on and so forth.
Mm-hmm. So lots of room. And I guess in some ways, you know, we hear that, and I've heard from here, that AI is being held to a higher standard than perhaps the existing models. Yeah. That's because the existing models are kind of understood, have been around for a while, people are comfortable with them being running. Yeah. Do you believe that? And is that inappropriate?
I think that's accurate. I don't know if it's inappropriate. I think, like, if we don't continually hold ourselves to a higher standard, then come on, right? Like, that should be what we're after continually. Yeah. It doesn't make it easier, because as YG said, like, deep learning, sometimes difficult to explain, but it is a higher standard in some regards.
Okay, good. Got about 10 minutes left. So we've got a couple of questions, and we'll open it up to the floor. You know, banks have been in the press a little bit, you know, recently over, I guess, kind of overselling would be the kind of term into their base. And there's lots of people out there who think one of the unintended consequences is I'm going to get people, I know more about them, it's contextual, they're vulnerable, and so it provides another opportunity to perhaps oversell. So just love to get your thoughts on that. And is there a flip side to that story about the types of things that you could do to help with that burden?
I mean, we were talking about pre-delinquency, which is a very interesting feature and a very, very interesting use case for a bank to leverage AI to make sure that they have a healthy portfolio of clients with credit. So I don't think that even though we know how banks make money, I don't think that the typical Canadian institution are really in the business of providing as much credit as possible to their clients. I think they're trying to have some level of maturity in who they lend money to and who they should stop lending money to.
Mm-hmm. Yeah, I think that's a relatively fair assessment. I mean, our organization is 160 years old this year. Our desire is to have all of you as clients for your entire lifetime. So overselling or overloading people with credit isn't in line with our strategic objective of having people be clients from, you know, the time they want a banking relationship till the time they no longer require one. You know, that's our view, and doing something that damages that relationship by putting someone into financial difficulty is just not something we can wrap our heads around. And if you look back at what happened in 2008 and 2009, Canadian banks came through that relatively clean because we're very diligent about who and why we lend money. And then the second thing is what general people probably don't know is that even when we grant credit to someone, if we allocate the credit and someone doesn't use it, it costs us money, which is it's really difficult because you need to be optimal, right? So just granting huge buckets of credit to people that don't use it actually makes us less profitable because we actually have a capital charge for that. So interestingly, it's much more an optimality problem for banks, and that's where things like machine learning work really well because, as Tom said, you're about optimizing something, an outcome, right? You're about optimizing returns with some thresholds or gates. Like you'll say, my PCL as an organization will never go above 25 basis points. With that constraint, please optimize, right? So we don't, it's not a part of our DNA for sure.
Cool. One question each, as we've kind of talked a lot about it. There's lots of innovation. There's opportunity to explore from a value perspective. Great question on how do you operationalize, what's going. This has kind of been at the company level. From an industry perspective, if there's kind of one thing, an inhibition or a blockage that could be removed or something that could be accelerated, what would each of you kind of give counsel to the industry as a whole?
Open banking, I guess.
So talk a little bit about why and how that would help your model and others.
Accessing the data right now is doable, and the proof is we're in the business of accessing the data. I think there is that barrier from large organizations that don't necessarily want to leverage that data as we're in the discussions with the government towards open banking regulations in Canada. So I think there is that kind of invisible barrier that is a huge blocking issue right now for large organizations to work with transactional data. So I would definitely say open banking is the thing.
Yeah, for me, I believe some version of open banking will come no matter what. So I'm not that fussed about working on that one because that will happen. One of the things the industry can do now that would actually be really beneficial is work together with the government regulators, et cetera, on the concepts of explainability. Because if you have a model that is much more predictive, but you can't explain the outcome versus a model which is much less predictive that you can explain just rationally from a science perspective, I have to question why.
Yeah.
Right? Now, there is work being done on explainability to break down deep learning models, et cetera. But there has to be a middle ground where if I can get to 99.8% accuracy with this and 96 here, why are we saying no? Right? Like that's, it's safer for the industry, safer for the economy, safer for the country within boundaries. And the thing is that the industry to work together to create those boundaries and construct would be a very valuable thing.
Yeah. One of the hotter postings on LinkedIn recently has been financial services regulators looking for machine learning people, right? So and data scientists. So it's interesting. Some people are catching up kind of along the way.
And if we can find them, we'll hire them.
Yes, they compete with the rest of us to get them. Anyway, so we've just got a couple of minutes left, so I thought I'd just open it up to the floor. Is there anything that we didn't cover that you would have kind of thought would be pertinent for everybody else? So.
David, you opened up the meeting, the panel, with an example where some of these decisions are highly complex. This is the mortgage, the investment, are highly complex, but they're also highly emotional.
Mm-hmm.
So how do you inject that emotional element into an increasingly emotionless world? I'm thinking about an example where, you've traditionally worked with a banker that's known you for 20 years, your kids play baseball together, you're now approaching them for that first mortgage, you're hoping, you're crossing your fingers, and all of a sudden your friendly avatar banker says, I'm sorry, Dave, I can't do that.
Yeah, I think, so our strategy inside the company, frankly, is about human augmentation. There's some cases where we'll use just AI in the raw, but when it comes to interacting with people, we don't see an easy way or even a desirable way in the near term to not have a human be a part of that advice. I've been in banking since 2003. And I remember getting my first mortgage in 2005 thinking my own organization is probably going to say no, right? And I worked there. I can only imagine people off the street how that feels, right? So, getting a human involved in that, but using, analytics, machine learning, AI, to allow that human to have better responses that are more tailored to that individual, and then spend the time on, because I don't know if you've ever been to a bank, but a lot of data collection. Instead of doing the data collection, start talking to people about what they want to accomplish or achieve or what their needs are in the context of the human, the person, instead of the context of the product. Right? And that's the work that has to be done.
Cool. We can take kind of maybe two more questions. So. Yeah.
Just the time out for White Cheese Airport.
Yeah, there we go. Okay, we can take one more question, and YG's got to get an ultrasound. So with that, nobody's asking a question.
It's a kidney. It's a kidney.
Yeah. You got to join his wife's ultrasound. Okay, well, I want to thank all of you. Kickoff, 8:30 in the morning. We had a good turnout, lively, lots of great questions. So we're impressed that Kenny came out and listened to us, so thank you. And I'd like to thank my two colleagues on stage for a great discussion. So, and I hope you all enjoy the rest of the conference. So thank you very much,
Thanks,
everyone.
everyone. Thanks, Steve.
Thank you.